Good afternoon, everyone, and thank you for joining us on our third quarter market outlook. I'm Anthony Palmer, Group Commercial Director for Carrick, and I'm joined by the familiar face of Rob Enslin, Director and Portfolio Manager for Linked Investment Managers. We're all on this call because there's been a lot going on in the markets, a really difficult time for everyone concerned. And Rob's going to help us really talk through, what has transpired from a high level perspective, and then obviously look at the markets going forward. So Rob, please, if you wouldn't mind helping us out here and talking about what's happened from a high level.
Good afternoon, ladies and gentlemen. And from my side, thank you very much for making yourselves available for this call. And I think your opening introduction is 100% correct. There's certainly been quite a challenging environment for investors after quite a decent runway that we've experienced for a number of years. For many of you on this call would have opened your June quarterly statements and seen significant drawdowns across strategies invested in. I think if we summarize it and we look at really what's transpired in the first 6 months of this year, we've moved to a very different outlook for inflation compared to what the market's original anticipation has been. And as a result, I think central banks have also moved significantly faster than what many of us were originally pricing into our models. What we've seen from the likes of the Federal Reserve, even the Bank of England, and to some extent in emerging markets, central banks have hiked interest rates at a very rapid speed. I think it's important to point out that the absolute level of interest rates is not at unprecedented levels, but what has been a disruption in markets is the speed and the pivotal shift that has transpired over the last 6 months. If we start looking a little bit forward, whilst inflation has been the dominant theme for the first 6 months of this year, we're starting to see the market's focus on economic growth outlooks becoming a little bit more prevalent. So the fear of potential recession is certainly going to be a discussion point in 2023. We're not necessarily at that point where economic activity is dead certain to go into recessions, but there are some anecdotal evidence and leading indicators that are suggesting that economic activity in parts of the world may be slowing. And as a result, portfolio construction, asset allocations, etc., is starting to take into account this potential threat in the markets.
Thanks for that. With that backdrop, how has that affected asset prices?
Yeah, so I think if we look at really what's happened over the last 6 months, and what I have in front of us is really a summary of the overall market in broad asset classes, and then a little bit more granular within the styles and the subsectors of the bonds. But the key takeaway from this slide is that it's a unique environment in the sense that both equities and bonds have seen significant drawdowns simultaneously this year. Now, normally speaking, in a typical market environment, you've been offered the protection of bonds in equity sell downs. This time around, quite different, which has meant that your multi-asset portfolios, whether they be cautious mandates, balanced mandates, have realized bigger drawdowns than what would be normally accepted in a normal environment. If I just quickly take you through the summary, what we're looking at is US dollar returns, emerging markets year to date around 17.6%, developed markets down around 20.5%. Within developed markets, the clear winner, relative winner, has been value-orientated companies and stocks. You can see from a value companies perspective down 12%, whilst quality companies and growth companies 24% and 28% respectively. It was also important to take into account longer-term track records. So whilst value styles have performed well over this period, if we take a 10-year view, both growth and quality have outperformed. And I think that just speaks to the importance of style blending. We tend to focus on diversification through assets as well as geographies and sectors. But the fourth element of diversification is in style blending. Now, various managers have different philosophies and approaches towards investing. At certain points in time, other styles will do better than others. But as inflation concerns have really increased, the market has found defense in value-orientated real economy type business models and sold, in particular, more growth-orientated companies where the earnings outlook is based on much stronger growth over a longer period of time. So in simple language, you're just discounting those earnings at a higher discount rate, and therefore their valuations have come down. Turning our attention to the bond segment of the market, you look at sovereign or government bonds, which is traditionally a very defensive, boring asset class in your portfolio, there to protect you. We've seen significant drawdowns there, down 14.3% over year to date. Investment grade bonds and even high yielding debt showing quite a similar payoff profile. So the real only places to have hidden during this period has been in the commodities. The onset of the invasion of Ukraine, coupled with tight supply demand dynamics, we're seeing quite a big move in commodity prices, up 35% odd. And then obviously sitting in cash as a long-term investor, certainly not a recommended strategy. You can see over 10 years, your annualized return is 0.8%. But as an asset class, from its defensive qualities in times of volatility, has held up relatively better than the other asset classes.
Thank you, Rob. In your opening statement, you spoke about inflation. That's a very, very topical, broad subject as well. If you can just drill down a little bit deeper into what it actually means.
Yeah, I think, and before we do that, I just want to touch on one more slide with regards to the extent of the drawdown in both bonds and equities. And if we take a sort of a 50-year window and we look at the performance on a calendar year of bonds and equities, we do certainly find ourselves in quite a peculiar environment. As you'll see on the slide, there's in the bottom left-hand quadrant, 2022. Now, if the calendar year ends up here, it's really, you can see quite clearly outside of the scope of what the market typically does. Over the last 50 years, there's been two other occasions where you've ended the year both negative on equities and bonds, and they were far more mild sort of drawdowns compared to what we were experiencing. So the takeaway there is someone who's in a typical 60-40 balance style portfolio, if we just look at the S&P 500 and the Bloomberg Aggregate Bond Index, you're looking at a drawdown year to date of around 16.2%. Now, if you compare that to other periods in the market, the only sort of comparable would be 2008, where your balanced portfolio was down around 20%. But there's quite a sharp difference there. The equity side of the equation was down 37%, while the bond side of the equation was actually positive 5.2%. So in that regard, we are in quite a unique environment. And I just think it's worthwhile sharing and pointing that out to clients. But if I take your earlier question on inflation versus growth, a good departure point is just to really look at where has inflation come from and what is really the root cause of inflation that we're suddenly experiencing across the globe. So over the last 30 years or so, it's fair to say that inflation has been somewhat benign. Post the 1970s, inflation has really been under control by central banks and therefore not a central theme to their thinking. Yes, from an interest rate hiking, cutting regime, they've kept a tight lid on it, but it's never really become de-anchored and a major concern. The other important point to make is that in a normal environment, inflation comes from the demand side of the equation, whereby there's only so many goods out there and so many people chasing those goods creates sort of a supply-demand dynamic where prices go up. That's quite a comfortable dynamic for central banks. Historically speaking, in that environment, you hike interest rates, you take away sort of the demand from the product by doing so because people's money in their pockets diminishes. And then ultimately, the economy slows, demand slows, and when it slows to such an extent, whether it be a mild recession or really weak economic growth, the same tool is applied in the opposite direction, whereby interest rates is cut and that stimulates demand, etc. This time around, though, one would argue that inflation is predominantly still from the supply side of the equation. There are examples of where demand has started to actually come through and also add to the inflation equation. But the root cause was really COVID-19, whereby we haven't ever experienced a globally connected economy simultaneously switch off at the same time as a result of COVID, and then suddenly switched back on. That created all sorts of price distortions, whether it be from bottlenecks in terms of a very rampant pickup in demand or orders as a result, once people were able to sort of COVID headwinds were alleviated. And then we can layer it with two other significant events. The second event was Russia's invasion of Ukraine. That created a distortion in terms of commodity supply and demand. And then the third would be China. So China is really experiencing its COVID waves at a very different time to the rest of the world. It's probably 2 years thereafter. And the stop-start opening and closing of economies collectively has created quite a price distortion. Now, the challenge for central banks in this type of environment is that the tool of interest rates used to tame inflation from a demand side might not necessarily be as applicable, or the market's response to it might not be as targeted through hiking interest rate because of the supply dynamic. Our view is that ultimately the supply-demand mismatch will eventually work its way through the system. We will find some level of equilibrium in that regard. At the same token, we do need to be conscious of economic growth. If you keep hiking interest rates, it will ultimately, even though it's a lagging effect, will impact consumer consumption, demand, etc. And therefore, that's a very delicate balancing act, I think, that central banks are tasked with at the moment, to try and get that alignment between not absolutely killing economic growth, but also getting inflation under control. And I think the next slide really just gives you a good illustration of the dilemma that central banks were faced with. At the turn of the year, on the left-hand side is what we're looking at, the Fed funds rate. Interest rates were cut near zero at all record time lows. And then suddenly we saw this very aggressive spike up on inflation. So that disconnect between inflation and interest rates became uncomfortably wide. I think sensibly and needed was that central banks needed to step in and hike interest rates. Since then, we've seen a very rampant move in interest rates, hikes in the US, the UK, Europe in a little bit more peculiar environment because economic growth, because of the war, etc., is exceptionally soft. So their ability to absorb that is a little bit more limited. But that really is the synopsis of where the interest rate hikes have come from. What has that meant? Well, that's really meant that when we were sitting at the end of last year, the outlook for interest rates across the world, and importantly, interest rates filter into the bond market, really is the discount factor and from which most asset prices are sort of calculated from, had a certain trajectory. Where we stand today, represented by the left-hand chart, you can see how the overall bond yield curve has shifted significantly up across the yield curve, and has meant that that has created a very volatile shift in asset pricing, and I would say at the heart of the sell-off that we've witnessed. Secondly to that has been the uncertainty of the Russian-Ukrainian war that's transpiring, as well as the ongoing COVID stop-starts from the China perspective. So if I bring that all sort of forward and what we think the second half of this year and certainly 2023 holds, is this balancing act between inflation outlook and economic growth. For the first half of this year, the pendulum was very much in favor of inflation outlook. We think we're getting much closer to peak inflation. How long the current levels that we experience sort of transpires, time will tell, but we would find it hard to see inflation continue to accelerate from current levels, and economic growth and indicators in that regard actually start to become a little bit more front of mind as they start to weaken, and that does need to come into the psychology of central banks as a collective. So with that, sort of an early indication for us is to look at the leading indicators. And we have seen some weakness in the leading indicators over the last couple of weeks and months. If we look at sort of the G7 economies, a composite leading indicator, you can see at the end of the curve there, it's changed direction, although not significantly deteriorated yet. It may be an indication of a change of trend. Business confidence, similarly, we've seen very weak business confidence out of the likes of the UK and broadly speaking across developed markets starting to emerge. And then the other important one is consumer confidence. We know that the US economy, GDP perspective, around 70% is derived from the consumer. So that is a very important input. And we've seen consumer confidence across the globe, even in emerging markets, come under severe pressure as the outlook, the certainty of outlook has deteriorated significantly over this period.
Thanks, Rob. Lots of information to consider, and a great summary of where we, what's led us to this point. What can we expect now going forward?
Yeah, absolutely. So I think in this type of very volatile environment, it's always a good idea to look at asset allocation from this 4-quadrant perspective. I think just to unpack it a little bit more in detail, one can argue that over the last decade or so post the financial crisis, we were probably living in the disinflation quadrant. So what we're looking at is on the one axis, we're looking at global growth, GDP, and on the other axis, we're looking at inflation. So why I say disinflation is that we had reasonably good GDP growth over the period. Some years were actually above expectations or trend, others less so. But collectively, I think it was a decent backdrop. But at the same time, inflation was quite benign. We never really saw a pickup of inflation. And in that type of disinflation or oversupply environment, your sort of more long dated, which we refer to them as long duration assets, tend to perform well. Now, a classic definition of that would be your technology type companies. Suddenly, and in a very short period of time, the market psychology has moved, and certainly the economic inputs support that, into a stagflation type backdrop, a scarcity of inputs. And whereby in that type of environment, on the one hand, inflation picks up, but at the same token, economic growth expectations deteriorate. So the last 6 months has been about that bottom right-hand quadrant, and it's played out pretty much textbook in hindsight. In that type of environment, the US dollar, cash, and oil, and then coupled with that, energy stocks tends to perform well. And I think allocations to those asset classes have certainly provided some protection for clients. If you ask me where we're going from here, I think we rather stay within that stagflation quadrant, or we move in the direction of the disinflation quadrant again. I find it a bit harder to foresee us moving into a depression where both economic growth and inflation dissipate. I think central banks will be forced to live with slightly high inflation to protect against economic growth. But yeah, we still live in a pretty tight supply-demand dynamic. And then even less so, a boom type of environment in the top right-hand, where both inflation and growth is very rampant. It's quite hard to see because I don't see very strong economic growth. So I think we live in one or two of those quadrants over the next medium term, if we have to really call it 12 months or so. And my base case is that we start moving more in the direction of disinflation. I think the base effects of inflation, earlier as I mentioned, supply-demand finds a little bit better equilibrium, and central banks ease off the rhetoric of higher interest rates, all collectively move us in that direction. The final point I want to make on this slide is it's important to realize that markets price assets 12 to 18 months forward. So although economic data that starts coming out may suggest that we're still in a stagflation environment, asset prices will respond way before that. And for everyone on this call, it is important to realize that the data that we may start receiving today as confirmation, asset prices will start pricing what 12 months, 18 months forward may look like. I think also worthwhile realizing the silver lining in everything that has transpired is that we've seen a significant derating of valuations. Now, that's a good thing. Things are generally cheaper across the board. If we look at equity markets going into the end of last year, it's fair to say that most equity markets were looking fair to fully valued, particularly the US was looking somewhat expensive. 6 months on, share prices have deteriorated significantly. We look at the likes of the US market trading on a 16.9 times multiple. That's slightly below the black block that represents the average. Europe is looking particularly cheap. Germany is trading on a 9.8 times multiple, and the same can be said for emerging markets. The question going forward, though, is we've seen a derating in the P, making the price to earnings multiple cheaper. The second half of this year, and we've got some big reporting over this period. What happens to the E? What happens to earnings? Does that economic slowdown start impacting companies' earnings? And then as a result, the market might not be as cheaply priced as what the visuals are showing us right now. From our perspective, it's not an all-out risk mitigation, but quality as a factor tends to, the predictability of those earnings and the robustness of their earnings is a little bit more powerful or predictable. And as a result, the type of managers that we're looking for in this environment are closely aligned to quality style investing.
Thanks, Rob. Great overview from a global perspective. South Africa, though, I do want to touch on, although it is a very small part of global GDP, a lot of our clients live in South Africa. So if you wouldn't mind touching on South Africa and what's going on from a sort of macro perspective.
Sure, absolutely. So I think it's fair to say that South Africa has actually relatively surprised over this period, despite all the headwinds that were thrown at South Africa leading from COVID to where we're at right now. Other than the lack of electricity, I think generally things have behaved pretty well. Asset prices have held up, relatively speaking, well. If we look at comparison year to date, if you were invested in the MSCI World and you were converting that back to rands, you were down 18.4%. That compares to the All Share Index or SA Equities down 8.3%. So that's about a 10% outperformance. Within the SA Equities, the broad sectors, financials, industrials, and resources, financials have been the outperformer, largely driven by cheaper valuations at the start of this year. The market's bought into that view. Industrial shares negatively impacted because a lot of the industrial shares are rand hedge type companies. So they're exposed to that global economic backdrop that we've just touched on. And then the resources have been quite volatile. Year to date, down 7.7% as commodity prices have eased in the last month or so on economic growth concerns. But there was a point in time where resources were actually strongly up over the period, benefiting from higher commodity prices because of inflation. Probably a bit disappointing, the SA bond market, really attractively priced at the moment, trading on a yield of around 10.5%. Therefore, very plausible that in a rolling one-year basis, a 12% type return is achievable from that sector, down 2% odd. And then your flexible income mandates, etc., achieving a positive return. So I think most investors have probably been a bit surprised by South Africa. Yes, the market is looking quite cheap. But I think the big underpin for South Africa over this period, the part that has really saved SA and even so the rand, has been a very attractive commodity backdrop. Now that has filtered through to the South African economy. The most tangible of that is our current account, which we've been running a surplus. It's also protected us from some input inflation. So the bottom right-hand chart just gives you an example of export commodity prices compared to the oil price. And you can see that despite higher energy prices, we've been protected through our exports of commodities. The top right-hand chart just gives you a visual of that current account surplus that we're running. I think this chart goes all the way back to the 90s. So we've suddenly been able to sort of our big deficits and our funding has been assisted as a result of this. And therefore the rand has, relatively speaking, held up pretty well, despite record unemployment, load shedding, and some of the structural issues that our economy faces. The rand up until recently trading in the 1450s, 15s, we thought was exceptionally strong. The last month or so, we've seen the rand blow out. There's a saying in the markets, the rand walks up the stairs and falls out the window, and that's classic rand behavior over this period. Where we're at today, our view is that the rand's probably fair value around 15.25 to 16.25. When we're in that zone, we would be comfortable to say that it's a fair value. Trading at 17, the pendulum feels that it's potentially probably swung a bit too hard. And it's not necessarily a rand issue, it's been more a dollar strength issue that's taken us in that direction. So yeah, South Africa is vulnerable. We've had, from a backdrop point of view, commodities have helped us. But if we start moving into a slowing global economic backdrop, I think that does place some pressure on the South African economy because of the commodity cycle. And then, yeah, we don't have much protection to sort of guard against higher input prices, weak economic activity, record unemployment levels. And if we just look more immediately, the South African Reserve Bank was criticized during COVID for being quite hawkish. And what I mean by hawkish is many argue that there was an opportunity to cut interest rates more aggressively than they did. Where we sit today, I think our Reserve Bank has actually done an exceptionally good job. They're one of the few central banks around the world that is, one could argue, is ahead of the inflation curve. We received last week a surprise interest rate hike of 75 basis points. The market was pricing in 50 basis points. And by all expectations, we're in for around another 1% of interest rate hikes, whether that be 50 and 50, etc. But most economists expect that to be the terminal or the peak level of the interest rate hiking cycle in South Africa. From then on out, we could very well start experiencing mild interest rate cuts, because on the right-hand side, we just give you an indication of what economic growth looks like. I just want to point out on the slide, this was just before the rate hike. So it's 25 basis points lower than what expectations were. We've actually taken interest rates up to 25 more than what the chart is suggesting. Similar to offshore markets, I think South African markets, most asset classes are actually looking pretty well priced from a bottom-up perspective. Our equity markets trading on around a 9 times P multiple. Within that, we would argue that the Rand hedge stocks look pretty attractive, as well as the resource stocks, financials a bit closer to fair value. And then the bond segment of our market on a 10.6% yield, I touched on it earlier. We think in a multi-asset South African portfolio looks pretty attractive, and we certainly have some exposure in our portfolio construction to that segment of the market.
Thanks, Rob. Fantastic overview. But how does that actually speak to how you or Linked is positioning their portfolios?
Yeah, so I'm going to touch on our process very briefly, just to assist in what the next 2 slides actually mean. From our perspective, before we enter into any mandate, let's take the example of a global balance mandate. We spend a lot of time understanding what an appropriate strategic asset allocation should look like. So what that means is we look at 20 years worth of data. We look at an optimal blend of assets that gives us the highest return for a given level of risk. And if I was using a very simple way of explaining that, if you made me put an investment portfolio together once off and leave it for the next 20 years, that would be my strategic asset allocation. Then we use our quarterly house meetings like this internally to discuss what sort of tactical asset allocation tilts we want to make around those strategic asset allocation views. It also acts as a mitigation tool for us, or risk mitigation tool, to almost remove the emotion. So the next 2 slides represents on our global mandates as well as our SA mandates, how we are tactically tilting our portfolios on a 12-month view. So we start off on the global markets, emerging markets. On a long-term basis, we would look to be marginally underweight. Going into the 3rd quarter, given what's transpired with valuations, we think it's appropriate to move the dial slightly up and hold a neutral weighting towards emerging market equities. On the developed market equity space, over a very long period of time, we would prefer to be marginally overweight. Going into this period, we think neutral is appropriate. Whilst on the bottom up perspective, valuations are attractive, there are still some significant headwinds and uncertainties in the market, and central banks are at risk of making a policy mistake. So all those factors considered, we would be comfortable with the neutral weighting. On the listed property side of things, we've actually moved tactically to marginally underweight. We think a slower economic backdrop, plus the effects of higher interest rates that have been pushed through in the last 6 months, starts to impact property prices, and therefore we marginally underweight. On the bond segment of the market, we've been underweight bonds for some time. We think that the payoff profile of bonds when yields were at record lows didn't really give you enough relative to the risk profile of those assets. It has somewhat played out. Over the last 6 months, we've seen big drawdowns and bond yields have improved. So we're slowly looking throughout the quarter at opportune times to build in some bond allocation into the portfolios. It's not a case of moving overnight, but slowly scaling into some bond allocations in the portfolio. And that will be largely funded from our currently overweight cash position and cash-like instruments in the portfolio. And then finally, on the commodity and inflation hedge side of the market, whilst we're seeing very high inflation prints now, and that could very much play out for the next couple of months, we think it is largely in the price of those assets for now. And as a result, we would be quite cautious to take an overweight call in commodities right now. And then I think finally, if we turn our attention to the local side of the market, equities, we've moved to sort of neutral call. We think valuations are particularly attractive. On the global equity side, through feeder fund type instruments, whilst we would strategically like an overweight there, similar to the offshore comments, we're holding a neutral view. Listed property also on the local front, marginally underweight. I think the same headwinds face the South African property sector, coupled with excess supply in our market. And then on the fixed income side, we have an all-out overweight call there, prefer to play it through flexible income funds because of their activity on the duration curve. And then different to the offshore markets, we think the South African asset prices gives you a real return where SA cash hasn't. So we are underweight on that cash side of things. I touched on it earlier, but if at a current handle of around 17, 16, 50 odd, we think that the rand is partially overdone. And as a result, although long-term we underweight the rand, for now we think that if you're looking to exit South African shores and take money abroad, I would wait a little longer. And if you're looking to bring money back to South African shores, we think it's actually quite attractively priced from that perspective. I think, and with that, that's our story as Linked, as investment house. I think we're in for another volatile 6 months, but as always, and even more so now, we'd encourage our clients to be long-term focused. I know it's something that as investment managers like to fall back on when times are challenging, but important to point out that sometimes there is a significant disconnect between the true intrinsic value of a company or an asset relative to the price that you're purchasing it. And in those disconnect periods, time is really what is important because ultimately the market will realize its true intrinsic values.
Absolutely. And, it's also always good to remember that, if you look historically, there are some very, very large intra-year drawdowns. And unfortunately, people do panic and you don't want to sell, you don't want to lock in those losses. Because you look back at those years, and at the end of the year, the markets have actually ended up in positive territory. So, that's a statistic that I always like to keep in mind. But thank you very much for that overview, Rob. We've got a little bit of time for questions, and I do see that some are coming through. The first one touches on commodities. I know that you briefly mentioned, commodities and your portfolio positioning, but the question is, should you be buying commodities at this particular point in the cycle?
Yes, I'm going to answer it from two sides. So from a micro bottom-up point of view, there's still very much a case to be had that through underinvestment in many commodities over the last decade, there's a structural supply-demand deficit, and that will underpin commodity prices for some time, and therefore make commodity companies, in terms of their profitability, sort of aligns quite nicely with that thesis. From a top-down perspective, though, I think it's a little bit more short-term, and I think the likes of the Russian-Ukrainian tensions that's created the supply-demand deficit, in our view, will ultimately ease. I think, although there's a lead-up time, the combination of US shale gas, equally the conclusion ultimately of the Russian-Ukrainian war, renewable energy sources that the globe is pushing forward with quite quickly, means that there may be some distortion there. And so putting the two together, yes, as always, diversification holds some commodities in your portfolio, but I wouldn't be going overweight at this point in time in commodities. That's quite different to some commodity companies, but I'm sure I don't think now's the time to be going aggressively into commodities.
Thank you. And then I'm smiling because the next question is something that we get a lot as financial advisors, and that is simply, if I'm sitting on cash now, should I carry on sitting on cash, or is it an opportune time to get into the markets?
I'm going to give you a very boring answer because I think it's the correct answer. I think your departure point is always important. So if you're planning on investing for the long term and you've gone through the necessary steps with your financial advisor and have a very clear understanding of your ability and willingness to take risk, and therefore investing in the appropriate investment strategy, then as always, time is your friend with regards to investing. The earlier you start and you stick to your financial goals and plans, theoretically, the better your returns are going to be. So that's the a theoretical answer, and I think it's still appropriate. If we try and bring it into some when's the right time and not the right time, which is a very hard question to answer, I think valuations are attractive in some parts of the market. There is some uncertainty, but I think that valuation opportunity overrides the uncertainty in our minds, and at least look to average into the market would be our recommendation. So if you're sitting with $100, an appropriate strategy in our minds would be to start with a $50 allocation, and then whether it be one or two chances thereafter in a couple of months would be our recommendation.
Yeah, I must agree with you absolutely on that. And then final question that's come through is just regarding the dollar and, talking about the demise of the dollar, and your views on that would be appreciated.
Yeah, so the simple answer is I don't see any demise of the dollar in the next 3 to 5 years. If we start talking 20 years out, it's too far for me to really have a view. I think many people have asked me over the last 3 years, are we seeing the demise of the dollar? Are we going to see a competing currency like the euro or the renminbi or even cryptocurrencies compete? The simple answer is the dollar remains the most liquid, widely available currency of the world. During times of panic, people tend to rely on the dollar. Equally, the dollar is one of the only economies that is prepared to stand as the lender of last resort. I think what's transpired in Europe has negatively impacted the euro over the last period. The same token, Brexit and the pound's relevance has diminished. From a Chinese economy perspective, we are seeing the rise of China, and China will ultimately become a much larger economy than the US. But the trust in the renminbi, the policies that its regulators implement, I think we are very far away from dethroning the dollar in that regard. And then at the same token, cryptocurrencies, whatever your view is or isn't on them, they haven't proved themselves to be a reliable source or store of value. Their volatility just simply throws, in my mind, that thesis out for now. So 3 to 5 years, the dollar remains king in my view.
All right, fantastic. Let's wrap it up for the day. Thank you again for joining us, Robin, for your time, and for our listeners, thank you very much. If you've got any further questions, please reach out to your Carrick advisor, and we look forward to seeing you on our next webinar.